What's up everybody, Gen X Dividend Investor here. In this video I show you some new fascinating information on the power of reinvesting dividends to both educate and motivate dividend investors. All I ask in return is to please hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. Take a look at this chart I found on an asset management site called Schroders, which shows the dramatic effect that reinvesting dividends can have on how much money your investments can make. The graph reflects a $1,000 investment into the MSCI World, which is an index that represents large and mid-cap companies across 23 developed markets. They looked at 1993 to 2018, which was the previous 25 years from when they did their analysis. The darker colored blue bars shows how the total portfolio would have grown just from price appreciation, and the orange bars represent the same portfolio but with reinvesting your dividends and buying more shares. So starting in 1993, the total portfolio value was at $1,000 and both bars are at the same height. From 93 to 2000, aka the dot-com run-up years, we see the total portfolio value growing, and we see that reinvesting small amounts of dividends lets the portfolio grow even faster. In 2000, the no-drip portfolio would be worth $2,861. But if you had been reinvesting dividends, then the portfolio would have been worth $3,269. So in 7 years of reinvestment, you would have a 14% larger portfolio. Then the dot-com crash hits and portfolio values fall until 2003 when things bottom out. Then the markets turn around and keep going up until the Great Recession banking crash of 2008. At the peak before the crash, your non-reinvestment portfolio would have been worth $3,196, which is over triple the starting investment. But a reinvested dividend portfolio would be worth $4,286, i.e. 34% larger. Then they crash again and they climb back up. In 2018, a reinvested dividend portfolio would have been worth $7,416 versus $4,231 for a portfolio that hadn't been reinvesting its dividends. That means reinvesting your dividends would yield you a 75% larger portfolio over those 25 years. So that's 5.9% annualized growth for not reinvesting versus 8.3% annualized growth if you had been reinvesting. In percentage terms, it's the difference between your money growing by 323% without dividends reinvested, or 640% with dividends reinvested, about twice as much. So that's a great example that highlights the power of reinvested dividends and letting your snowball compounding grow. Of course, what happened in the past doesn't mean it'll happen in the future, and this doesn't account for inflation or taxes, but regardless, it shows you how important it can be to reinvest those dividends. The article said that reinvesting dividends is one of the most powerful tools available for boosting returns over time. They then looked at a bunch of different stock markets to compare how reinvesting dividends impacted total returns in those indexes. There's some really interesting data here. It's sorted based on which index had the most returns when reinvesting dividends. Number 1 was the Hang Seng, aka the Hong Kong Index, where reinvesting dividends gave you a 10.7% annualized return over 25 years. Amazing. Compare that to 7% returns if you hadn't been reinvesting. And then you see the S&P 500 is next at 9.7% annualized returns versus 7.5% if you excluded reinvesting dividends. Two things surprised me about that information. Number 1 is that the Hang Seng with dividends reinvested outperformed the S&P 500 over 25 years, and number 2 is that if you didn't reinvest your dividends, then the S&P 500 comes out on top. So it looks like the yield and dividend growth in the Hang Seng was better than the S&P 500. I had no idea. Next in the list is the MSCI World that I just elaborated on with those graphs. And then we have the FTSE 100 UK Index, where it's interesting to note that reinvesting dividends would have yielded a 7.8% annualized return as compared to 4.1% for not reinvesting, which means that dripping would have almost doubled your annualized return. Incredible. Then you have the CAC 40, which is France, which looks similar to the FTSE 100. Then we come to Japan, which has had a struggling economy for a long time, and we see that you would have only gotten 1.3% annualized returns without reinvesting dividends, or over double that to 2.8% annualized returns if your drip had been on. Dividends are very powerful for growing your portfolio. Things get even crazier when you look at the Chinese index, where if you had invested in it from 1993 to 2018, your annual return excluding dividends would actually be negative 0.5%, i.e. your portfolio value would have basically gone sideways for 2 decades doing nothing. But, and you know I like buts, if you had been reinvesting those Chinese dividends, then you would have eked out a 2% annualized return. Hopefully that hammers out the case of why you want to reinvest your dividends. And retirement accounts are usually a great way to avoid having to deal with any taxation issues that can come from reinvested dividends. Overall, the average annual growth across those 8 markets without dividend reinvestment was 4.3%, but jumps to 7.1% on average when you reinvest your divvies. Nice. Now let's focus on the S&P 500 a bit more, since most of my viewers are people who invest in it. I found an article on wealthycorner.com that said that the annual return of the S&P 500 without dividends reinvested was about 6.6% over the last 100 years ending in 2021. However, if you had been reinvesting your dividends, your return would have been 10.7% a year. A similar story is found in this graph, which shows S&P 500 returns over the last few decades. They said if you'd invested $1,000 into the S&P 500 around 50 years ago, then at the end of 2021 you would have had $39,000 without dividends reinvested versus $131,000 with dividends reinvested. That's over 3 times more. Over that period of time, the average annual dividend yield was 3% and stock appreciation was 8%, making the total annualized return 11%. These days stock prices have been going up faster than dividend increases, so the overall yield of the S&P 500 is only around 1.4%, which is another reason why people say the market's too hot. As stocks fall, yields tend to get pushed up. Of course, if a bunch of companies lower their dividends, then yields get pushed down. Also note that when you see graphs like these, they are usually called price returns or price indexes, which shows the stock price return but it doesn't include reinvested dividends. If they show the return of reinvested dividends, then they'd probably call it a total return chart. Okay, another interesting graph I found on Wealthy Corner was this one, which graphs earnings and dividends of the S&P 500 over the last 50 years, adjusted for inflation. They concluded 2 key points. Number 1 is that dividend growth has outpaced inflation. Specifically, the S&P 500 dividend CAGR over all those decades averaged 6% per year. I looked it up and found that inflation in the US averaged 3.45% per year between 1950 and 2020. The other point they concluded was that dividend growth is stable relative to S&P 500 earnings, and even more stable relative to S&P 500 index price. Make sure that first point sinks in, which is that dividend growth has outpaced inflation, on average, over the long term. It's a good thing to remember, especially for you folks who get irked when dividend hikes are less than inflation, in particular years for particular companies. Like a few days ago I posted how Altria just did a 4.4% dividend hike. And then a viewer responded that Altria's raise didn't beat out inflation this year. That's true, but you probably don't want to use an edge case year of historically high inflation coupled with one of MO's lower dividend raises to conclude too much. Sure, inflation might stay high for a while, and sure, Altria could do small dividend hikes or even cut or suspend their dividend, but I've usually found it helpful to look at trends over longer periods of time. Not always, just usually. Altria has been one of the best returning companies over the last 50 years. And in the last 6 years, their dividend hike percentage has averaged about 8% a year, so it's almost always beaten inflation. However, Altria's returns were during the heyday of tobacco, so who knows what the future will bring. When you look at the last 5 years, it tells a different story. Now, I highly doubt that Altria will be one of the best returning companies over the next 50 years, unless they unleash some really innovative and healthier products. Now, to be fair, I think the viewer's comment was a bit tongue-in-cheek, but I thought it'd be good to use as an example. Of course, if you have a company that is consistently doing smaller dividend hikes than inflation, then maybe it doesn't meet your needs. But it might still be a reasonable investment if its total returns are good. Bottom line, I would look at broader timeframes when analyzing things, while also recognizing that companies can completely change overnight due to a plethora of reasons. A nice thing is that when you take all the companies in the S&P 500 and factor in all their hikes over long periods of time, they outpace inflation. Anyways, I don't agree with everything said on that site, as almost all sites have some issues, and I would encourage you all to watch a recent video I did called Dividend Investors Should Care About Total Returns to better understand my perspectives on things. Whatever you do, make sure to always focus on great companies, not just great dividends. Remember, dividends aren't a guarantee. Okay, now let's take a look at a tool of mine in my dividend spreadsheet product. It's called the Portfolio Growth Simulator, and it's basically a dividend reinvestment calculator, and I'm now showing you a beta version of it, as this has some new features I've not yet released to my Patreon aristocrats and kings, aka the people who get to use my spreadsheet. My old version only showed your account value and dividend income, assuming you had your drip on, whereas this new version shows you both drip and no drip growth. Anyways, you can put in a portfolio value, or use the default, which is at 10 grand now. Then you put in an average weighted dividend CAGR, and I picked 8.24% for a reason which I'll explain in a moment. Then you put in an average weighted starting yield, and I have 3.3% in here right now. Then the share price field you can ignore, it's just used to model your portfolio. Then we have a field which you can put in how much you want your share price to go up each quarter, and right now it says 2%, which is equal to 8.24% a year, aka 2% compounded 4 times added together. And that's why I put in an 8.24% dividend CAGR. If your dividend CAGR percentage is higher than your share price increase percentage, then over time your dividend yield will keep increasing, as I'll show you in a moment. If your dividend CAGR percentage is less than your share price increase percentage, then over time your dividend yield will head towards zero. And if your CAGR percentage is the same as your share price increase percentage, then your yield remains basically the same. And then there's a field you can use if you want to simulate investing more cash into your portfolio. In this case, I put in $200 a quarter for fun. Okay, so in this example portfolio of 10 grand with its 8.24% dividend CAGR and a 3.3% starting yield, where its share price are going up 2% a quarter and we're depositing $200 a quarter into it, we see that it initially yields $330 a year. At year 10, we see that a no-drip portfolio value would be at about 28 grand versus a drip portfolio of about 39 grand. And we see a year 10 no-drip annual dividend income of $937 versus a drip portfolio dividend income of $1,299 a year. No drip basically means you are spending all your dividends rather than reinvesting them. And then I show your 20, 30, 40, and 50 values, and then down below you can scroll through each quarter's date of growth through all those decades. Actually, I show through year 60 down below. Obviously, the further you go out, the less you can rely on estimating tools like this, but it's interesting nonetheless. Like at year 50, we see that a no-drip portfolio value is at almost 826 grand versus a drip portfolio which would be worth $3.9 million. And this no-drip portfolio at year 50 would be making over $27,000 in dividends a year versus 130 grand for a portfolio that had been dripping all that time. Now remember that's just an estimate and doesn't account for tax or inflation, but it does help illustrate the power of dividend compounding over time. Now watch what happens as we change some values. Let's up the dividend CAGR to be 10% while holding the other values the same. Now you can see how your portfolio value in the drip case went up dramatically and in fact hits $8.6 million at year 50. Also, your annual dividend income has gone up dramatically to $624 grand a year. Wow. But since your dividend CAGR is 10% and your overall share price is going up at a bit more than 8% a year, your yield slowly trends up over time. Now, if we have your share price grow faster on a percentage basis than your CAGR, watch what happens. So if you look at your yield over time, you can see how it's trending down as you'd expect. It's a really fun tool to play with because it lets you see the relationship between yield, dividend CAGR, share price appreciation, and investing more money or not into your portfolio. I find it motivating to be able to see info like this, even though it has its caveats. And motivation is good to help keep you positive whenever the markets or your portfolio or whatever are bothering you. So if you enjoyed any of this video, I'd really appreciate it if you please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. Finally, please consider joining my free Dividend Discord chat server if you haven't yet. It has thousands of investors on it and it's growing all the time. Thanks for watching, stay positive, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.